First step of the strategy, you need to trade a strong trend. So we're going to look at the daily, weekly, and monthly time frames to make sure that on all three, gold is indeed trending upwards each time. We want to see an uptrend on the monthly, we want to see an uptrend on the weekly, and we want to see an uptrend on the daily. That will allow us to conclude that on gold, across all the major time frames, the trend is strongly bullish. And what we're going to do is follow this strong bullish trend in day trading. Now, we'll switch to the 15-minute time frame to really get into this strategy, which is perfectly suited for a beginner trader and, as you'll see, is easy to understand and put into practice. Gold is very bullish on the monthly, weekly, and daily charts. So, what we're going to do is look for buying opportunities and wait for bullish trends to form on the smaller time frames, like the 15-minute, 30-minute, or even the 5-minute charts. So, I'm going to use the bullish liquidity to do my day trading. Whenever the market dips, I'll be looking to buy each time. As you can see, I've drawn some trend lines, and trend lines are very interesting to use. They allow you to trade trend line breakouts to the upside when the market turns bullish again on the smaller time frames, so you can take advantage of this bullish liquidity since the gold chart is very bullish. You can see that in an uptrend, the market is always making a bullish impulse, then a correction, another bullish impulse, then another correction. You'll also notice there are no technical indicators on this chart because I use price action and Fibonacci as a bonus to get even more precise entry points. Let's start from the beginning of this trend, and as you can see here, we're going to set up, at the break of the trend line, the start of a strong upward trend. This rise will yield about 1,000 pips in total, so that's pretty huge. There's a lot of money to be made when you know how to follow the trend. And so, since we're not fortune tellers, we'll always wait for the start of the trend to take shape. You can't catch this move because you're not a mind reader. It's dangerous to buy here while the market is bearish. So here, obviously, we don't buy. On the other hand, when the market starts to show buying strength and begins to signal that it wants to resume an upward trend, that's when we start to take an interest. The first huge buy signal at the start of this trend is right here. First, what we're going to do is take the Fibonacci from the low point of the upward movement to the high point here. What do we notice? We see that there's a break of the downward trend line here, which gives a buy signal at this spot. Next, we have the Fibonacci retracement, which gives us a very important level at the 38.2% retracement, providing a second buy signal. And the final signal that really triggers the official buy on your trading account is this 15-minute candle that completely engulfs the previous candle at the key 38.2% level, all while knowing that behind us we have a strong uptrend on the monthly, weekly, and daily charts, and that the break of the trend line signals the start of a new bullish trend. Quite simply, you have your buy signal with this candle. You wait for the candlestick to close on the 15-minute chart, and you can enter directly here, or wait for the break of this small downward trend line here for even more security. Here, you make your purchase at $3,340. And once you've bought, what do you do next? First, you set your stop loss below the 15-minute candle here, actually below the last low. You leave a bit of room, which gives you a stop loss at around $3,330, so a stop loss of 100 pips. If you have a stop loss of 100 pips, you want to aim for at least double that for your first take profit, so 200 pips. You set your take profit 200 pips higher, with a risk-reward ratio of 1:2. You should always adjust your stop loss placements below the lows if you're buying. And for taking profits, you need to move up to higher time frames, draw your key price zones, and then set those price zones as your targets. You can also use Fibonacci to project your target profit. Let's see what happens next. You can see that after the upward move you caught thanks to the 3-step strategy one just gave you, well, you can see that the market then puts in a correction. That's what it does every time. Upward move, small correction, upward move, small correction, until the market completely reverses. And so here, the market is going to move around like this in a slight downward correction. So, first, we'll use Fibonacci again to check where the correction is on our Fibonacci retracement. You can see that the correction here comes to about the 50%, 61.8% Fibonacci retracement levels. These are two very, very important zones as well, along with the 38.2%. That already gives us a first signal that the market isn't reversing the trend downward, but is simply making a slight correction before heading back up. Here, the perfect signal is at the break of the trend line. You take the break of the trend line, and once again, you wait for the 15-minute candle to close before buying. You set the stop loss here, below the recent lows, and you always have a risk-reward ratio of at least 2 to 1. You can see here that your entry price won't be reached by the market. The market won't come close to threatening your break-even. It will then go on to make your move afterwards. Here, you have another correction taking shape. And if we have some fun by drawing Fibonacci from the low point to the high point of the move, we can see that the market comes back to correct almost exactly at the 38.2% retracement once again. At that point, we have further confirmation that this is just a correction and that we can confidently buy again when a signal appears. And as luck would have it, the signal is right here. As you can see, just like in the first example, we have an engulfing candle over the previous one, which gives a strong buy signal. For those who want even more security, you can once again wait for the break of the downward trend line to buy at the candle close here. So, you can buy either here or here after the close of the bullish engulfing candle. Same as before, you set the stop loss below the last low point and aim for a first take profit with at least a 2 to 1 risk-reward ratio. Here, the market gives you a breakout. Here, you have to take profits thanks to this strategy. And as you can see, the market very often makes these correction moves that you can trade by being patient during the correction, using Fibonacci to find your entry prices, to make sure the market is only making a correction and not a trend reversal to the downside. And you can see that every time I showed you a Fibonacci, the market would come back to correct either at the 38.2%, the 50% retracement, or the 61.8% Fibonacci retracement. Once you have your levels, and the market confirms to you that it's just a correction and that the market is going to move back up, you need to wait for the breakout signal of the trend line. That's it for this strategy. I encourage you to practice putting it into action, and I'll see you very soon on the YouTube channel.